Welcome to our reading on multinational operations with me, John Bone. Now, what we're really talking about here is exchange rates and how their fluctuation affects the company. Now, really with exchange rates, we talk about three different exposures: economic exposure, transaction exposure, and translation exposure. Now, economic exposure focuses on the competitiveness of your imports and exports and how they're affected by long-run movements in the exchange rate. And of course, that's really an issue for our economics area of the syllabus. So here in financial reporting analysis, we're going to be looking at transaction exposure and translation exposure. Transaction exposure is really looking at imports and exports denominated in overseas currencies. And the issue is the exchange rate may well change between entering a contract and settling a contract. And that will give us exchange rate gains and losses. Translation exposure is really looking at having overseas subsidiaries and needing to convert their income statements and balance sheets back to our reporting currency for consolidation purposes at year end. Now let's start our look at this by looking at transaction exposure. We're asked here to describe what transaction exposure is and to analyse the effects on the accounts. Okay, so we're talking about having imports and exports that have been denominated in an overseas currency. Now, initially, when we record either the sale or the purchase, we're going to record it at the exchange rate at the date of transaction, i.e. when the sale is made or when the purchase is made. Now, of course, the receipt of payment, either cash coming in if we've made an export sale, or of course cash leaving the business if we've made an import purchase, is going to be at a later date. So we're really saying that this is affecting credit sales and credit purchases. Now, the idea is the exchange rate may well have changed between entering the transaction and settling the transaction. So let's imagine that we've got an export sale denominated in an overseas currency. So let's say we're a UK firm and we've sold goods in dollars. Now, of course, when we receive the dollars from the customer, we have to convert them back into pounds. So if the pound is weakened against the dollar, we're going to receive less pounds than we were expecting. But if the pound has strengthened against the dollar, we're going to receive more pounds. Now, the idea, the difference in what we were expecting to receive and what we actually received due to movements in the exchange rate, that's going to be reported in the income statement as essentially a gain if we're receiving more currency, or a loss if we're receiving less. Purchases, of course, work the other way around. If we end up paying less than we're expecting, that's going to give us a gain. If we end up paying more than we're expecting, that's going to give us a loss. So typically, we report the exchange rate gain or loss through our income statement. But what about the situation where you make a sale in one period, but you don't collect the cash until after the balance sheet date? Well, let's have a little look at this. Settlement after the balance sheet date. What we have to do is a kind of mark-to-market exercise. So what we're going to do is look at the exchange rate on the balance sheet date and calculate either an exchange rate gain or loss at that point, and then a further exchange rate gain or loss will be calculated at the actual date of settlement. In other words, one exchange rate gain or loss, an unrealized gain or loss if you like, is being recorded in the income statement. Then we hit the balance sheet date, and then in next year's income statement, when we actually settle, there's going to be a further exchange rate gain or loss. Now, this rather tells us whether we're expecting to see transaction gains or transaction losses. So let's have a look at the export sale. So we record the sale at the exchange rate at the time we make the sale. Our exposure is our accounts receivable. Initially, that's recorded, of course, equal to the sale. In other words, using the exchange rate at the date of transaction. But when we receive the cash in, we're either going to receive more money or less money than we were expecting when we convert back to our domestic currency. Okay, so let's say we've made an export sale. If the foreign currency, the overseas currency, strengthens, that's going to be good news against our domestic currency. Because, of course, what that means is when we receive the foreign currency and we convert back to our domestic currency, we actually have more of our domestic currency. So if you've made an export sale and the overseas currency strengthens, we're going to get gains. Now, of course, conversely, if we've made an export sale and the overseas currency weakens, that's going to give us losses. Why? Because when we receive the monetary amount, when we convert back into our domestic currency, essentially it's going to buy less of our domestic currency, less than we were expecting. Now, of course, with import purchases, it's just the other way around. Here, our exposure is the liability, our accounts payable. Now, of course, if the foreign currency strengthens, that's going to be bad news, because that means it's going to take more of our domestic currency now to pay off this liability. So we're going to get exchange rate losses. Now, of course, if the foreign currency weakens against our domestic currency, that's going to be good news, because now essentially it takes less of our domestic currency to pay off our liability. So we get exchange rate gains. Now remember, with transaction exposures, these gains and losses are going to hit the income statement. In fact, both international accounting standards and US GAAP require transaction gains and losses to be reported in the income statement. But here's the problem. Neither of them tell us where in the income statement they need to be reported. In other words, should we include it as an part of our operating income or operating expenses, i.e. part of the normal course of business, or is it outside the normal course of business? Should it be a non-operating income or expense? Okay, so there's no guidance on this, and of course what that means is it's going to reduce the comparability between companies. Certainly it's going to distort the comparison of operating margins when we look at different companies. So that's our transaction exposure, and again we'll take you through some numerical examples of that in class. Let's turn our attention now to translation exposure. So here's the idea: you've got overseas subsidiaries and you need to convert those overseas subsidiaries to your reporting currency at the balance sheet date in order to produce your consolidated financial statements. Now notice we have a three-step process here. Step one, it says, identify the subsidiary's functional currency. Now we're going to define exactly what a functional currency is in just a second. Now, step two, once we've identified the functional currency, we need to convert foreign currency balances into that functional currency. So in other words, the subsidiary's local accounts might not be in the functional currency, and if that's the case, we need to convert from the local currency into the functional currency. That's step two. Now, once we've got the amounts in the functional currency, then finally we're going to need to convert from the functional currency to the parent's reporting currency. Again, if the parent's reporting and functional currencies differ. So potentially three steps: local currency into functional currency, then functional currency into reporting currency. Now, our learning outcome asks us to be able to define between our different currencies, or distinguish between functional, presentational and local currency. Let's start off with presentational and local currencies because those are the most straightforward. Let's start with local. Local currency is simply the currency in which your overseas subsidiary produces its local accounts, its domestic accounts. The presentational currency, of course, otherwise known as the reporting currency, is simply going to be the currency in which you produce your consolidated financial statements. Remember, consolidated financial statements or group financial statements contain all divisions of the company. Now, functional currency is going to be slightly trickier for us. Now, again, the phrases we need to note here is the currency of the primary economic environment in which the firm operates. Now, when we say firm here, we're talking about the subsidiary. So it's the primary currency, primary economic environment in which the firm operates. Have we got any rules to identify what is this primary currency? Well, it typically is the currency in which your subsidiary generates and spends cash. Now, again, note some subjectivity here. Okay, let's have a little look at if there's any guidance to spot the functional currency. Now, international accounting standards do give us some nice guidance here. Number one, they say, it's the currency that influences the sales price. Okay, so the currency in which you sell your goods. Now, most people would say, surely that's the same as the local currency of the subsidiary. Not necessarily. Let's imagine that you're an oil producer and you're in the UK. You might be, therefore, your local currency might be sterling, but when it comes to recording sales and transactions, it might well be the US dollar, for example. So local and functional currencies can certainly differ. So certainly the currency that influences your sales price, the currency in which your sales are denominated, a very key driver here. Notice the second point, the currency of the country whose competitive forces and regulations determine your sales price. Okay, so I think step 1 and step 2 are the most important. It's really therefore the functional currency is the currency that dominates and drives your sales. Now point 3 says the currency in which funds from financing activities are generated. Well, of course, financing activities are typically raising debt and equity. So we'd look at the currency in which we issue our bonds. Step 4, currency in which receipts from operating activities are retained. Now, what we're simply saying is, look, maybe our subsidiary retains and reinvests its profits, in which case its local currency might well be the functional currency. Alternatively, we might have a subsidiary that remits its earnings back to the parent by way of dividend, in which case we might find that the reporting currency, the parent's currency, is the functional currency. Now, to that end, they talk about looking at the subsidiary's autonomy. Now, if you have a totally autonomous subsidiary, what does that really mean? It means your subsidiary is making its own investing, financing, operating decisions. Then chances are the local currency is the functional currency. Now, let's look at a subsidiary with very little autonomy. In other words, a subsidiary that is really dominated by the parent. The parent makes the investing, the operating, the financing decisions. Here, it's far more likely that the parent's currency is the functional currency. So the degree of autonomy is important. Okay, point 6 says look at the currency that influences the cost of production. So this is going to be the currency in which you make your material purchases, maybe the currency in which you pay wages, etc. Another influence. Financing from the parent to service debt. This is saying if your overseas subsidiary has issued debt but relies on cash flows from the parents to service the debt, then again, typically the parent's currency, the reporting currency, becomes the functional currency. Remittance of cash flows to the parent, well again dividends. If big dividends are being paid back to the parent, again the parent's currency is often the functional currency. And then the final point, transactions with parent. So what this is saying is maybe a lot of our sales are intergroup sales rather than external third-party sales. Again, the more reliant you are on intergroup sales, the more likely that the parent's currency, the reporting currency, is equal to the functional currency. So International Accounting Standards gives a list of factors to really consider. I think the most important ones for the exam, though, are the ones that drive your sales revenue. So currency in which you're selling goods, currency which actually determines the overall selling price. Now, our learning outcome asks us to compare and evaluate the two methods we have to convert our financial statements. And notice we've got two methods, one called the temporal method, and one called the current rate method. We need to know for our exam how they affect the balance sheet, how they affect the income statement, and which method is appropriate. Now in practice, as we said, it could be a three-step process. You might need to go from local currency to functional currency, and then from functional currency to reporting currency. In our exam, however, we're likely to only have two currencies. In other words, the functional currency is likely to be the same as the presentational currency, in which case we use the temporal method, or the functional currency is going to be the same as the local currency, in which case we use the all current rate method. So notice, if the functional currency is the same as the presentational currency, our top example here, all we have to do is go from the local currency accounts into the functional stroke presentational, in which case we use the temporal method. Now our temporal method is certainly going to be the harder of the two methods. Again, just be aware of an alternative name for the temporal method, can be referred to as remeasurement. Now, the alternative method, of course, if our local currency is the functional currency, then we just need to go from local stroke functional into presentational, and that is the current rate method. Again, just be aware of its alternative name, translation. Now, with these alternative names, of course, the examiner likes to say, using the remeasurement method, because he knows that most CFA candidates have learnt it as temporal and all current, so just by saying remeasurement, panic sets into the exam room. So I used to think, wouldn't it make sense if the alternative names started with the same letter? In other words, T for temporal, T for translation. But when we look at it, that's clearly not the way it works. So I used to remember, that's an insight into the crazy way maybe my brain works. So it's actually T for temporal, R for remeasurement, C for current, and T for translation. Okay, so don't match the temporal with the translation. Don't match your T's, and you'll always get this right. Right, a little bit of exchange rate definitions, because we're certainly going to be asked to calculate the translation effects. So we actually do need to be able to convert balance sheets and income statements using our two methods. First of all, a little bit of definitions. When we talk about the current exchange rate, we're simply talking about the exchange rate at the balance sheet date, so the closing balance sheet date. We might call that the current exchange rate. Sometimes we refer to it as the closing exchange rate. So simply what the exchange rate is on the balance sheet date. Now the average exchange rate is simply a weighted average exchange rate during the year. We're going to see that kicks in when we look at income statements in a while. Then we also have historic exchange rates. These are the exchange rates at a date of a particular transaction. In particular, when you bought things like PP&E or when you issued equity. So this is a fixed exchange rate at the date of a specific transaction. Right, let's start off with our temporal method. Remember, we need to explain the effects on the financial statements, and we're asked to also calculate those effects. So, alternative names for temporal, we've already said, T for temporal, R for remeasurement. Don't match the T's, remember. Otherwise known as the monetary non-monetary method. Why? Because the temporal method is going to look at monetary assets and liabilities and non-monetary assets and liabilities and treat them differently. Now that does lead to the question, what is a monetary asset or liability? And I'll explain that in a second. Now notice it views the overseas operation as an extension of the parent company's activities. Okay, so it's not really an investment, it's just an extension of the parent company's activities. What we therefore want to do is use exchange rates that preserve the measurement basis, in particular for things like our non-monetary assets and liabilities, things like fixed assets, etc. We don't want them to fluctuate over time just because exchange rates fluctuate over time. Okay, so we notice our measurement basis are either current value or historic cost in this case. Now notice with our temporal method, of course, we're using it when the functional currency is the same as the parent's reporting currency, i.e. the presentational currency. So we're going from local into functional stroke reporting. Again, remember we said we use the temporal when our subsidiary is really an integrated subsidiary. It hasn't got autonomy. So it's just an extension of the parent. Okay, so let's have a look at the temporal method. Now, it says our monetary assets and liabilities are converted at the current rate. What is a monetary asset or liability? It is any asset or liability that is either cash or is going to be converted into cash or settled in cash. So here are the classics for our exam. So it's cash itself, accounts receivable, of course we collect the cash from the customer, accounts payable, we pay cash to our suppliers, short-term debt, long-term debt, of course we're paying interest and principal, all leading to cash inflows or outflows. Now when you have a monetary asset or liability, we're going to use the current rate, the closing exchange rate, because we're going to argue that these cash flows are affected by exchange rates. If the exchange rate suddenly weakens or strengthens, that is affecting the amount of cash essentially that we're paying or receiving from our suppliers. Now, our other assets and liabilities, defined as our non-monetary assets and liabilities, remember, we don't want these to be exposed to exchange rate fluctuations. And the reason, remember, we said, is we want to preserve the measurement basis, either historic cost or, of course, the fair values. Now, notice, therefore, when we look at our assets and liabilities, when we look at our monetary assets and liabilities, first of all, the first thing to note is most of them are assets. It's our PP&E, our intangibles, and also, of course, our inventory. Now, those are going to be converted at the historic rate. The historic rate meaning the exchange rate at the date of the transaction rather than the exchange rate at the date of the balance sheet. Now what that means is fluctuating exchange rates will not affect those non-monetary assets and liabilities. That way, of course, the measurement base is actually maintained over time. Now, one question I get is inventory here sitting at cost in your balance sheet. Isn't that a monetary asset? People ask me, because essentially you're going to sell your inventory. Now, be a bit careful here. Typically, when we sell our inventory on credit, the inventory is a non-monetary asset, but when we sell it on credit, of course, the accounts receivable, the trade receivables, those are a monetary asset. So it's not the inventory, it's the accounts receivable that is the monetary asset. Now, capital stock, and here we're really talking about our common stock and our additional paid-in capital. We're going to use the historic rate when that equity was issued. And then, of course, our total equity, notice it says it's going to be at a mixed rate. Why? Because of retained earnings. Now, retained earnings, of course, are coming from the income statement. Now, let's have a look at our income statement. Most revenues and expenses are going to be converted at the average exchange rate during the year. But there are some exceptions to this rule, and those are our cost of goods sold. Now, our cost of goods sold theoretically should be computed at essentially historic rates. So our beginning inventory should be the historic exchange rate, i.e. the exchange rates used when those purchases were made. Our purchases, each individual purchase, should be converted at the exchange rate at the time of the purchase. And our ending inventory should be converted at the exchange rate used for the purchases contained within ending inventory. Now, that is going to be a mammoth calculation on the exam. So often our examiner will give us a simplification here. What he often says is purchases were made evenly throughout the year. Now, what that allows us to do, whilst we still have to worry about using essentially historic exchange rates for beginning inventory and ending inventory, it does allow us to use average exchange rates for our purchases, thus simplifying the calculation to some extent. Depreciation and amortization, well, of course, PP&E and intangibles are non-monetary assets in the balance sheet. So whatever exchange rate we use, i.e. the historic exchange rate that we use for them in the balance sheet, we use the same historic exchange rate for the depreciation and amortization in the income statement. Now, notice as well, exchange rate gains and losses under the temporal method will go through the income statement. So under the temporal method, our exchange rate gain or loss through the income statement. Now, the only other thing we need to mention is dividends in a question. If you see dividends, then they are going to be converted at the historic rate when those dividends were proposed. And again, the examiner will tell you the exchange rate when the dividends were proposed. Okay, so let's have a look at the method of the temporal method. We're going to start by producing the top of our balance sheet and calculating total assets. So things like PP&E, things like intangibles, non-monetary, so we use the historic rate when that PP&E was purchased, when those intangibles were purchased. Okay, cash, accounts receivable, monetary assets, so we're going to use the closing rate for them. And we total it down to get our total assets. Now, of course, by definition, once we've got our total assets, we have liabilities plus equity. Remember, our balance sheet must balance always assets equal liabilities and equity due to the double entry bookkeeping system. So once you've got assets, you've also got liabilities and equity. So what we're now going to do is try and produce the bottom of the balance sheet. Now, it turns out that most of our liabilities are going to be monetary because we typically settle them by paying out cash, whether that's our current liabilities, things like purchases, or if you like, accounts payable relating to purchases, or things like debt instruments. Typically, they lead to cash outflows. So chances are in our exam, all of our liabilities are going to be converted at the current rate, i.e. the closing rate at the balance sheet date. Common stock additional paid-in capital, we said historic rate when that equity was issued. Now, retained earnings, we're just going to get as a plug figure. So in other words, we've converted the liabilities, we've converted the common stock and additional paid-in capital, we know what liabilities and equity must be, so we get our retained earnings as a plug figure. And I use the little beta here simply to indicate plug figure. That's all it means. So I now know my retained earnings. So I move to step 3. Step 3 says, look, we've got our closing retained earnings. We got that from step 2. We'll know what opening retained earnings were because they're simply last year's closing retained earnings, so those are going to be given to us in a question. If we've got any dividends, we can actually convert those at the exchange rate when the dividend was proposed. Then we're going to get the net income figure as a balancing figure. So again, it's a plug figure to make this reconciliation work. So we now know what net income needs to be in the income statement so that our income statement agrees with the balance sheet. So we move to step 4. Now step 4, we're going to produce the income statement itself. Sales, average rate. Cost of goods sold, historic rate. Most of our expenses are going to be at average rate. Again, be on the lookout for depreciation and amortization. We use the same historic rate that we use for the non-monetary assets in the balance sheet. Now when we total up our income statement, the net income that we get is going to be different from the net income that we got in step 3, our reconciliation of retained earnings. So what do? We force the income statement to agree to the balance sheet. So what we're going to do is put in an exchange rate gain or loss so that the net income in our income statement agrees to the net income from our reconciliation of retained earnings. Is this really an exchange rate gain or loss? Not really. It's really a plug figure that we're putting into the income statement to get the income statement to agree with the balance sheet. But again, if we called it, oh my goodness, the income statement doesn't agree to the balance sheet, let's force it, that looks unprofessional. So we call it an exchange rate gain or loss. It looks a little bit more that this is a legitimate item. But in reality, we're going to see that it isn't a genuine exchange rate gain or loss. It's not an economic exchange rate gain or loss. It's really coming from some items being converted at the historic rate in the balance sheet, some items being converted at closing rates in the balance sheet, some items are average in the income statement, some at historic. Plus, on top of that, there's the exchange rate fluctuation in the closing exchange rate. So be aware, when we look at translation gains and losses, exchange rate gains and losses, they're not genuine economic gains and losses. They're not real costs to the company. A lot of it is driven by the methodology that we're using. In fact, so much so that we can often see that using the temporal method might generate an exchange rate gain, but using the all current rate method might give us an exchange rate loss. Okay, so we are asked to calculate, so let us have a go at actually calculating under the temporal method. So we've got a firm here called Super Incorporated. It's a US firm. So that's our reporting currency, the US dollar. And we've got a subsidiary called Hoops Limited that is in Europe. And we've been given some exchange rates there. So it must be euro to the dollar if our subsidiary is European. Now, be careful with exchange rates here. We're converting from the local currency, the subsidiary's currency, to the reporting currency. So we always need the exchange rate to be quoted in terms of the parent's currency here, the US firm's currency. So in other words, you need the euro to be your base currency, the dollar to be your quoted currency in this case. We're going from base into quoted. So again, just be careful in the exam. Make sure the exchange rates have been given the right way up. In other words, with the correct quoted and base currencies. One trick would be to give them with the wrong quoted and base, requiring you to take the reciprocals before you do any calculations. Okay, so we're told the opening exchange rate at the beginning of our year is €1 to $150. Closing exchange rate, €1 to $180. Average exchange rate during the year, $1.65 per euro. The historic rate, and we're told this applies to beginning inventory, PP&E, common stock, and our opening retained earnings, $150. Now, of course, in practice, each non-monetary asset or liability has its own unique historic rate. But again, we're just applying one historic rate to the lot for simplicity's purpose in this example. We're also told dividend declaration was made when the exchange rate was 175 per euro. And then finally, a little tiny bit of extra information. The ending inventory was purchased at a weighted exchange rate of 170. So we're going to need that because remember, our beginning and ending inventories need to be converted at historic rate of the purchases contained within them. Right, okay, so let's turn our attention to the actual data. We've been given balance sheets, 2 years worth of balance sheets here for hoops. We can see we've got cash, monetary asset, accounts receivable, monetary asset, inventory. Now again, remember inventory is typically a non-monetary asset and PP&E a non-monetary asset. So 2 monetary assets, 2 non-monetary assets. We look at the bottom of our balance sheet, so liabilities and equity, accounts payable, monetary liability, dividends payable. Well, again, dividends payable, remember we used the historic rate at the time the dividend was proposed. Long-term debt, again, our long-term debt essentially here is going to be a monetary liability. Common stock, of course, is historic. We're going to use the historic rate when the common stock and additional paid-in capital were first recorded. And then we've got retained earnings, which, as we said earlier, is really going to be a bit of a mixture, largely because, of course, it's coming from the income statements. So we've got our balance sheets. Let's turn our attention to the income statement. So a nice, simple income statement here. Sales, average rate, cost of goods sold. Theoretically, it should be historic for each component, i.e. beginning inventory, purchases and ending inventory. But again, unless we know the exchange rate for every individual purchase, then it typically will apply the average exchange rate to purchases. Depreciation, of course, because the PP&E in the balance sheets at historic rates, we're going to use the same historic rate for our depreciation. Sales, general and admin is going to be an average rate, so are tax provisions as well. Okay, that takes us down to net income. So let's start. Step 1, remember, was to calculate total assets. So the cash, the accounts receivable are going to be at the closing exchange rate in the year, and of course that was an exchange rate of $1.80. The inventory, well, we're told the historic rate for the ending inventory, and we're told it was purchased at a weighted average exchange rate of 170, so we're going to use that for our inventory. And then finally our PP&E, we're told to use the historic rate of $1.50 for our PP&E. So let's convert these balances across. 1,080, 1,080, 850, 1,950, total them up, and we've got our total assets, $4,960. So we've converted our assets from euros, the local currency, to dollars, the reporting currency. Okay, so let's turn our attention now to the bottom of the balance sheet. Now the first thing is we know what liabilities and equity must come to get the balance sheet to balance. Given our assets were 4,960, liabilities plus equity must be 4,960. So let's run down our liabilities. Accounts payable is going to be, of course, at it's a monetary asset, so that monetary liability, I should say, so that will be closing rate. Dividends payable, historic rate when they're declared. Well, actually, I should say the dividend will be at the historic rate when declared. Dividends payable, of course, that's a monetary liability because we're going to settle it in cash, so we should use the closing rate for that. Long-term debt, closing rate again, $1.80. The common stock, and really we're saying common stock and additional paid-in capital, historic rate when they were issued. Now, of course, let's convert those over. 360, 180, 2,700 and 750. We then get the retained earnings as our plug figure so that it totals 4,960. So let's just add those balances. 360 plus 180 plus 2,700 plus 750. That brings us to 3,990. We need to get to 4,960, so our plug figure is going to be $970. Now this is our closing retained earnings. So we've done step 1, we've done step 2. We can now move to step 3. Now step 3 is to produce our reconciliation of retained earnings. We know our closing retained earnings from step 2, that's the 970. We actually know our opening retained earnings as well. Now our opening retained earnings, of course, are 200 euros essentially here. We can take that out of last year's balance sheet, and we were told to apply a historic rate for opening retained earnings of $1.50. So that gives us a figure of 300. Now the dividend, we're going to convert that at the exchange rate when the dividend was declared, and we're told that that is 175. Net income, we're simply going to get as a balancing figure here. So we need to total 970, so our plug figure therefore must be 345. So let's just check that out. 300 plus 845 minus 175, indeed we get to 970. Okay, so we've produced the balance sheet. We actually now know what net income needs to be in the income statement so that the balance sheet and income statement will agree. So we now produce our income statement. Sales, going to be straightforward, that's the average rate. Cost of goods sold, it's going to need a working here, and we're going to do that on the next slide. So I'll tell you what the number is right now, but we're going to see essentially how we arrived at that number on the next slide. Depreciation, use the same historic rate that you used for PP&E in the balance sheet. Sales, general and admin, tax, we're going to simply use average rates. So here's our numbers. 1.65, the average rate, convert your sales, $4,950. Cost of goods sold, we'll have a look at a working in just a second, $2,570, bringing us down to a gross profit of $2,380. Depreciation at the historic rate, $300, sales general admin at the average rate, $825, tax at the average rate, $165. Now if you add down that, so $2,380 our gross profit, minus $300, minus $825, minus $165, you get to 1,090. But our ending net income, our bottom line needs to be 845, otherwise our income statement isn't going to agree to the balance sheet. So what we now do is we force the income statement to agree to the balance sheet by plugging in a loss figure that takes us from 1,090 down to 845. So we essentially put in a loss of 245 that brings us down to the proper net income figure. Now, in the accounts, it sits there as an exchange rate loss in this case. Is it a genuine loss? Is it a real economic loss? Not to the company. No, not really. It's really caused by the methodology that we're using to convert these balances across. So don't think of it as a genuine economic loss. And this is the significance that we're saying here. We're saying transaction gains and losses on our imports and exports, those are genuine economic gains and losses to the company. If they're too big, we should consider hedging them. But translation gains and losses, a lot of this is to do with the accounting methodology that we're using, and therefore they're not genuine gains and losses to the company. Okay, let's have a look at how we got that cost of goods sold figure now, just to wrap this up. Now, by looking at the income statement for Hoops, we can see the cost of goods sold is 1,600. By looking at the X7 and X8 balance sheets, we can see our inventory last year was 300. That's our beginning inventory this year, of course. And our ending inventory this year in the 20X8 balance sheet is essentially 500. So armed with that, we can now work out what the purchases figure must have been. The purchases figure, of course, essentially, if we take the 1,600, add back the 500, deduct the 300, then we're going to get our purchases. So we're getting this as a plug figure, 1,800. Now, in our question, we were told strictly to use the 1.5 historic rate for our beginning inventory. We're told to use the 1.7 historic rate for our ending inventory, and we're going to make the assumption that the purchases were made evenly throughout the year and therefore apply the average rate to those. So those are our exchange rates. Let's apply those, and that's how we got the 2,570. Okay, so that's the temporal method. Certainly the harder of the two methods. Let's turn our attention now to the current rate method. Now, of course, we're going to use our current rate method when the local currency is the functional currency. So the local is the functional, so all we now need to do is go from local stroke functional into the parent's reporting currency, into the presentational currency. Now, again, of course, its alternative name, translation. Remember, we really want it to be T for temporal, T for translation, but we need to remember that that's not the case. Okay. Now, this views the overseas operation as an investment. And because it views the overseas operation as an investment, the entire balance sheet, in other words, all of the assets and liabilities are exposed to exchange rate risk. We're not worried about preserving the measurement bases in this case. Okay, now, as well, because we view it as an investment, we're going to keep the exchange rate gains and losses in our stockholders' equity, and we're only going to release them to the income statement when we realise them. When do we realise them? Well, when we physically dispose of this overseas subsidiary. So notice, what we're going to plug into our stockholders' equity is something called the CTA, the Cumulative Translation Adjustment. It's just the running total, a cumulative balance of all the exchange rate gains and losses that have been generated essentially on this overseas subsidiary. It sits in stockholders' equity until we dispose of this subsidiary, and if we do, then we release the Cumulative Translation Adjustment out of equity and into the income statement. A bit like available for sale securities in that respect. So let's look at the current rate method. Now, the beauty of the current rate method is it never talks about monetary assets or liabilities. In fact, all assets and liabilities are converted at the closing rate, because we say, remember, this is an investment, and therefore the entire balance sheet is exposed to exchange rate risk. So all of our assets and liabilities are going to be converted at the closing rate. Common stock, additional paid-in capital, will be at the historic rate when it was issued. Now, retained earnings. Let's think about our retained earnings. It says an accumulated average rate. I think this is slightly misleading. It isn't necessarily purely accumulated average rates due to dividends. But we're also going to plug in our cumulative foreign exchange gain or loss, the CTA as we tend to call it. Now, look, if all of the assets and liabilities are at the closing rate, then net assets are at the closing rate. And remember, of course, assets equals liabilities plus equity. Rearrange that, assets minus liabilities equal equity. Well, if all of our assets and liabilities are at the closing rate, when we look at equity en masse, i.e. all of the component elements together, that must also be at closing rate or it wouldn't balance. And that's exactly, essentially, what this cumulative translation adjustment figure is doing. We're plugging it into stockholders' equity so that equity agrees to net assets. And if net assets are at closing rate, then the total of equity, i.e. the common stock, the retained earnings, and this CTA must be at closing. Now, the income statement, again, is going to be very, very straightforward to us. Every single item is going to be at average rate. In fact, the only time we really see historic rates are with our common stock and additional paid-in capital, and also dividends. Any dividends that have been proposed are going to be converted at the historic rate when they are declared. Okay, so let's look at the methodology. Different starting point with the current rate method. What we're going to do is we're going to start with the income statement. Now, every item in the income statement is converted at the average rate. So we can take a shortcut if we want and just convert net income at the average rate. Then we move to step 2. So we've already got net income from step 1. Opening retained earnings are just last year's closing retained earnings. If we have any dividends, those dividends will be at the historic rate during the year. And that allows us to calculate our closing retained earnings. So essentially, this time we're working down, no plug figures involved. Opening retained earnings plus net income from the income statement, essentially minus dividends, and that's going to give us our closing retained earnings. Now, I have to be, and I should have really mentioned this earlier when we're doing our previous example, you do need to be a bit of a detective sometimes to spot dividends if you haven't been told what they are. Remember, you should be able to spot the dividend proposed by looking at the change in retained earnings and comparing it to that year's net income. If the change in retained earnings is smaller than that year's net income, then the difference, of course, must be the dividend proposed. Now, once we've got the income statement, we look at our balance sheet. All of the assets and liabilities are going to be converted at the current rate. Okay. Then we turn our attention to equity. Common stock, additional paid-in capital, historic rate. Retained earnings, from our earlier calculation, we bring those in. And if we total the balance sheet at this stage, it doesn't balance. In other words, assets minus liabilities do not equal equity. The difference is going to be our cumulative translation adjustment. So we're going to plug in a CTA just to get the top and the bottom of the balance sheet to balance. So we're going to force our balance sheet to balance by including the cumulative translation adjustment. Now, just be a little bit careful here. If the examiner asks you for this year's gain or loss, It's not the cumulative translation adjustment. Why? Well, the name is the clue is in the first word here, cumulative. This is the total exchange rate gain or loss under the all current rate method. If we're after this year's gain or loss, we need to look at the change in the cumulative translation adjustment from last year's balance sheet to this year's balance sheet. Okay, so let's have a look at it for our example, hoops. Now, of course, everything in the income statement is at the average rate, so we're going to convert the whole lot at our exchange rate of 1.65. There we go, beautiful, dead straightforward. Of course, if we were feeling like taking a shortcut, we could have just taken our net income and multiplied it by 1.65 to get, of course, net income in dollars. So much quicker. We haven't got this blend of average and historic in the income statement. Okay, now we move to our reconciliation of retained earnings. We're told our opening retained earnings, well again we'll be given this number, but let's use the same historic rate that we had before. So that's going to be $300. Net income is just coming from the income statement, the dividend, and of course we can calculate this dividend if you want to spot where this 100 came from. And I didn't talk about it when we did the temporal method, so let's talk about it now. If we turn to our income statement in euros, we've got 600 euros of net income. When we look at our balance sheet, you can see that retained earnings was 200 last year, 700 this year, so it's increased by 500. So net income was essentially 600, but retained earnings have only gone up by 500. The difference must be the dividend, so we must have declared a dividend of 100. And we're going to use the historic rate when that dividend was proposed. So those are our balances. Opening retained earnings 300, net income 990, dividend 175. Add down and we've got our closing retained earnings that we're going to transfer straight into our balance sheet, 1,115. So let's turn our attention to the balance sheet now. Start with your total assets because again this is going to be incredibly straightforward. Every single one of our assets is converted at the closing rate, i.e. 1.8. So again, if we're being a bit lazy, we could just take total assets and multiply by 1.8 to get 5,400. So we've got our assets. Once you know assets, of course, liabilities plus equity must also total 5,400 in order for the balance sheet to balance. So let's convert the bottom of our balance sheet. Accounts payable, closing rate, 1.8. Dividends payable, closing rate, 1.8. Long-term debt, closing rate, 1.8. All of your liabilities are going to be converted at the closing rate. Common stock, additional paid in capital, remember it's historic, and in our example that's 1.5. Retained earnings, we're just pulling from our previous computation. We worked out our retained earnings earlier to be 1,115. Now look at the issue that we have. If we total this, it's not going to add to 5,400. So let's actually have a look at what we've got. So 360 plus 180 plus 2,700 plus 750 plus 1115, and actually we get to 5,105. So we're now going to force the balance sheet to agree to 5,400 by plugging in the difference, so 295, and we're going to refer to that as a cumulative translation adjustment. Again, maybe a better name for it would be, oh my goodness, my balance sheet doesn't balance, I better force it to. But again, that would appear unprofessional. Much better to call it a cumulative translation adjustment and confuse people. Now again, if I was asked what the exchange rate gain or loss was, it would be the change in the cumulative translation adjustment between last year's balance sheet and this year's balance sheet. Now, calculating currency exposure. Is it possible to tell whether you've got an exchange rate gain or loss without doing any calculations under the two methods? And the answer is yes. What you have to do is look at your exposure. Now your exposure in the balance sheet is anything that is converted at the closing rate, because of course as the closing exchange rate fluctuates over time, these monetary assets and liabilities are going to fluctuate. So what we look at is all of the monetary assets, which in our example are just cash and accounts receivable. So monetary assets less our monetary liabilities. Now notice when we do that, we've only got a few monetary assets, cash and accounts receivable. The really big assets, PP&E, intangibles, inventory, are deemed to be non-monetary under the temporal method and therefore are not exposed to closing exchange rate fluctuations. Whereas when we look at the liabilities, the vast majority of our liabilities are essentially monetary. So what we often find under the temporal method is we have essentially a monetary liability overall. So let's say a monetary net liability. So take monetary assets, deduct monetary liabilities. Often, therefore, we get a monetary net liability. Even if total assets, if net assets are positive, monetary net assets are often negative. Now, under the current rate method, of course, what's exposed to the closing rate? It's all of our assets, all of our liabilities. So it's much more likely to be a positive number, a monetary net asset, a net asset position. Now, these are the accounts that are affected by the balance sheet accounts that are affected by both methods. Now, from this, we should be able to tell whether we're expecting to see an exchange rate gain or loss. And I put this little table together to help you with this. So let's look at the temporal method. If you did have monetary net assets, and I have to say that's a bit unlikely, then if the overseas currency appreciates, that gives you a gain. Why? Because if the overseas currency appreciates, it buys more of the reporting currency. So when you convert these monetary net assets, they get bigger in the reporting currency. Bigger assets, that's a good thing, we get a gain. Now, of course, if you have a monetary net asset position and you get a depreciating overseas currency, that's a bad thing because your monetary net assets are going to appear smaller when you convert them into the presentational currency. So you get a loss. Now, net assets, under the current rate method, of course, we are going to see net assets. Now, again, therefore, an appreciating overseas currency is a good thing because it's going to make these net assets bigger in the presentational currency, whereas a depreciating overseas currency is a bad thing because it's going to make these net assets appear smaller in the overseas currency. Remember, if your overseas currency appreciates, it buys more of the reporting currency. If the overseas currency depreciates, it buys less of the reporting currency. Now, here's the kicker. Under the temporal method, we said it's more likely that you have net monetary liabilities than net monetary assets. Now notice, with an appreciating overseas currency, this will make these monetary net assets bigger. Is having bigger liabilities, if you like, is having bigger monetary liabilities a good thing? No, and therefore we get a loss. Whereas, if the overseas currency depreciates, that's going to make the monetary net liabilities appear smaller in the reporting currency, so we get a gain. So here's the kicker. You could have an appreciating overseas currency, and if you use the all current rate method, you'd get a gain, but if you use the temporal method, you'll report an exchange rate loss. Likewise, maybe you've got a depreciating overseas currency. If you use the current rate method, it would give you a loss. But if you use the temporal method, it would give you a gain. And that really illustrates how, how these gains and losses are not true economic gains and losses. They're really driven by the accounting methodology that we're looking at here. Okay, now, no question in the exam would be complete without asking us to analyse ratios. And in fact, the learning outcome specifically talks about calculating ratios. It says, analyse the impact of the methods on financial statements and ratios. Okay, so let's compare local currency. So this is, in our example, that was the euro, to the amounts converted using the current rate method. Now notice, if we're looking at a pure ratio, there is no distortion at all. Now, what is a pure ratio? A pure ratio is simply a ratio where both the numerator and denominator come from the income statement, or both the numerator and denominator come from the balance sheet. So with a pure ratio, we don't pick up on any distortion at all. The reason being, all the income statement items are at the average rate under the current rate method, all the balance sheet items are at the closing rate. So in other words, the local currency and the or current rate method give you the same ratios for pure ratios. Now once we start to look at mixed ratios, that's no longer the case. Here, maybe the numerator is from the income statement, the denominator from the balance sheet, or vice versa. Now here, we're going to pick up on distortions, because the income statement item is at the average, whereas the balance sheet item is at the closing. So you do get distortions here. So notice, when we look at mixed ratios, we are going to get distortion. Now, what about temporal ratios? Now the distortions are going to be massive. Even the pure ratios are going to be distorted. Because if we're looking at a pure balance sheet ratio, the balance sheet item could be at closing, it could be at historic. If we're looking at an income statement pure ratio, the income statement items could be at average, they could be at historic. So we're really going to pick up on a lot of distortions under the temporal method. Now, often in our exam, our examiner will ask us to compare temporal versus current, and it's certainly more difficult than comparing local versus current rate method. So really we're going to have to analyze each ratio individually. Look at the numerator, ask ourselves, what are we converting this at? Is it average? Is it closing? Is it historic? Do exactly the same for the denominator, and therefore ask ourselves, how is this ratio being affected? Is it going to be larger? Is it going to be smaller? Okay, so really our steps here is the local currency, is the overseas currency appreciating or depreciating? If it's appreciating, anything converted at the closing rate is going to get bigger. If it's depreciating, anything converted at the closing rate is going to get smaller. We then need to examine our numerator. What rate do we translate it at? Is it the current? Is it the average? Therefore, is that going to make our numerator bigger under the temporal method compared to the current rate method, or smaller? Once we've done that, we turn our attention to the denominator of the ratio and we repeat. Okay, so what rate is it being translated at? Is it current? Is it average? Is it historic? Will it be bigger or smaller? Once we've done that, we can then determine the impact on the ratio overall. So let's have a little example. Let's have a look at fixed asset turnover. Now, fixed asset turnover, of course, is sales over our fixed assets. Okay, so there's our ratio, sales over fixed assets. Now, we've decided in this situation we've got a local currency that is appreciating. So the closing rate is bigger than the average rate. The closing rate, the ending rate is bigger than the average rate, is bigger than the starting rate or the beginning rate. Now the numerator, sales, whether you're looking at temporal, whether you're looking at all current method, it's going to be converted at the average rate. So there's no impact at all on the numerator of this ratio of the method that we use. So it's got to be about the fixed assets, and of course it is. Under the temporal method, those fixed assets, PP&E, are going to be converted at historic, whereas of course under the all current rate method, they're going to be converted at the closing rate. So we now need to compare the historic rate to the closing rate and say which one gives us the higher fixed assets. Okay, now essentially assuming that the closing rate is bigger than the historic rate, and we are making an assumption there that the historic rate is smaller than the closing rate. If that's the case, then the temporal method, because it uses a lower historic rate, gives us lower fixed assets and therefore a higher fixed asset turnover. Only of course, if that historic rate is lower than the closing rate. And that's the kind of approach that you're going to have to take for the exam. Right, let's have a look. What I've done is actually computed some ratios for our example, Hoops Limited. And I've done them in the local currency, i.e. the euro, I've done the temporal ratios, and I've done the current rate ratios. Now, first of all, look at gross margin. Of course, gross margin is gross profit over sales. Two income statement items, i.e. it's a pure ratio. And lo and behold, when we look at it, in the local currency, 46.7, and the current rate method, again, 46.7. So notice the pure ratio is not distorted under the current rate method. When we look at a temporal method, though, we have got a distortion compared to the local currency, and again, it's probably because that cost of goods sold is at historic rates. Let's look at the net margin, net income over sales. Again, it's a pure ratio. So local currency and, of course, the current rate ratio, no distortions at all. They're the same. Pure ratio again. But when we look at the temporal method, even pure ratios are distorted. Again, we've got items in the income statement at average, and we've got some items, cost of goods sold, depreciation, amortization, at historic. So we're picking up on distortions there. Let's look at a pure ratio in the balance sheet, debt to equity. Debt being a balance sheet item, equity being a balance sheet item. Again, when we look at the pure ratios, notice no distortion under the current rate method. But of course, when we pick up the temporal, we are seeing distortions. Again, balance sheet items could be at closing, they could be at historic. Okay, let's have a look at now pure ratios. So inventory turnover. Now I've got here, so essentially cost of goods sold divided by average inventory or ending inventory. Now, of course, inventory is the balance sheet, cost of goods sold the income statement. So notice now, even our pure ratios are being even our current rate ratios are being distorted. So with mixed ratios, even current rate ratios are distorted because the income statement item is at average, the balance sheet item is at closing. No surprise with our temporal method, again, huge sources of distortion. Income statement item could be at average or historic. And of course, balance sheet items can be at average, at closing or historic. Now, actually, with cost of goods sold, of course, that's going to be at historic in the inventory, and of course, ending inventory is going to be at historic in the balance sheet. Trouble is, different historic rates. Again, another bunch of mixed ratios here. Accounts receivable turnover, sales divided by accounts receivable. So sales at average. Accounts receivable, of course, monetary asset, so at closing rate. So notice, actually, with this one, the temporal and the current rate method give you the same result because sales is at average on both and accounts receivable are converted at closing on both. Asset turnover, sales divided by total assets. So again, it's a mixed ratio. So notice our local currency and our current rate ratio being distorted. We've got the same here, local currency and temporal, but that is just a wild fluke. Because again, if you think about asset turnover, sales over total assets. Well, sales is at average, but your total assets is a blend of either closing or historic. So there's no reason why the local currency ratio and the temporal ratio would be the same, other than a rather strange fluke here. Return on equity, net income from the income statement over stockholders' equity. So again, we're picking up on a mixed ratio. So again, therefore, both current rate and temporal rate showing distortions compared to the local currency. Same with return on assets, net income over total assets. We're picking up distortions there as well. So note, you're really going to have to analyze these mixed ratios in particular, line by line, to work out what happens to the ratio. Now, our next little learning outcome says, we need to analyze alternative methods for converting overseas subsidiaries that operate in hyperinflationary environments. So I think we need to start off here with our definition of what hyperinflation is. Per US GAAP, it defines hyperinflation as a 3-year compound inflation rate greater than 100%. Okay, so in other words, prices essentially doubling over a 3-year period per US GAAP. Now, hyperinflation gives us a problem. Typically, countries that have very high exchange rates witness very rapidly countries with very high inflation rates, I should say, witness very rapidly depreciating exchange rates. A high, of course, inflation rate means your exports are going to be less competitive, less demand for your exports, your currency values start to slide. So, in hyperinflation, if we use the current rate method, the issue is we're using closing exchange rates. So closing exchange rates, and those closing exchange rates would have depreciated dramatically because of the inflation. Now this gives us an issue when we look at our non-monetary assets and liabilities. Because in reality, non-monetary assets and liabilities are not really affected by inflation. Take some PP&E. So we've got some PP&E, property, plant and equipment, in an overseas subsidiary. And we're using the all current rate method. Now the problem is, in the accounts, it sits there at historic cost less accumulated depreciation. So if we take that figure and we apply an exchange rate that's rapidly depreciated, when we convert it into our reporting currency, the amount is going to shrink down to a tiny amount, purely due to the massively devalued exchange rate. Now, actually, that's not reflecting the true economic substance of what's going on here. Because whilst the exchange rate may be depreciating, inflation is meaning the fair value of your PP&E is increasing in the other direction. So actually, maybe in the reporting currency, we want the PP&E to remain roughly the same as it's been in the past. So notice, therefore, if you use the closing rate method in a hyperinflationary environment, you get the problem known as disappearing plant. Things that are converted, or things that are in the balance sheet at historic rates, non-monetary assets and liabilities at historic rates, will appear to get very, very small when you convert them, because you're converting a historic cost in the balance sheet and you're applying an exchange rate that's rapidly devalued. Now again, as we said, not capturing the economic substance here, because in reality the non-monetary asset or liability has inflated in value due to that hyperinflation. Now US GAAP has a very nice, neat way of getting around this. It says, well look, if the problem is that we're applying a devaluing exchange rate to essentially a non-monetary asset or liability, let's stop doing that. In other words, let's not use the current rate method, let's use the temporal method. Now, the temporal method, if you remember, uses historic exchange rates to convert monetary assets and liabilities, or sorry, non-monetary assets and liabilities. So in this situation, things like PP&E will apply the historic exchange rate to them, not the devalued current exchange rate, and therefore they'll appear at their historic values when we convert them into the reporting currency. They don't shrink, they don't disappear. So a nice, neat method, therefore, for the temporal method. Simply use the temporal method and apply historic rates to non-monetary assets and liabilities. Now again, notice we're saying that monetary assets and liabilities are affected by inflation, because essentially these are monetary amounts and the purchasing power of that currency has been reduced by the hyperinflation. Now, wouldn't it be nice if international accounting standards did the same as US GAAP? And I think the answer is yes, but of course it doesn't. International accounting standards has an alternative method. It says you can still use the current rate method, but instead, to get around the problem of the disappearing plant, any non-monetary asset or liability is going to need to be indexed up. So we're going to inflate the amount up in the balance sheet and then apply the devalued exchange rate. Okay, now again, I think this is taking it a little bit far, but have a little awareness of it. So non-monetary assets and liabilities are going to be restated using some form of inflation index, a price index, from the date they were acquired to the balance sheet date. If you've got revalued assets in your balance sheet, then it's from the date of revaluation to the balance sheet date. Monetary assets and liabilities are not restated. Again, these genuinely are affected by inflation, because remember, these are going to be settled by receiving cash, or of course settled by paying out cash or receiving cash, and that cash value is going to diminish in a hyperinflationary environment, so we don't restate those. Equity, notice we do have to restate. We do this by essentially applying the price index from the start of the year to the end of the year to the balance sheet date. If equity was issued during the year, then it's from the date of issuance to the balance sheet date. Notice as well, we've got to do the same in the income statement. So revenues and expenses are restated by looking at the change in the index from the date of the transaction to the balance sheet date. Again, that seems a bit long-winded for sales, etc., and cost of goods sold, but there you go. Now, what this means essentially is we get a purchasing power gain or loss in our income statement. Now, if we have net monetary assets, then essentially we're going to get a purchasing power loss in the income statement. Why? Because the purchasing power of these monetary amounts has been eroded by the inflation. Not good news. The monetary value of these net assets is declining. If you have a net monetary liability exposure, then it's good news. Again, the purchasing power of these liabilities is declining, smaller liabilities is good news, and therefore you get a gain. So notice monetary net assets in a hyperinflationary environment gives you a purchasing power loss. Monetary net liabilities gives you a purchasing power gain. Notice those gains and losses are actually recorded in the income statement. Now this just compares the temporal method, i.e. US GAAP method, to the International Financial Reporting Standards method. Now what it's really designed to identify is, whilst they're using totally different methodology, overall they give you a rather similar result. Because of course, remember, with a net monetary liability exposure, if the overseas currency depreciates, it means those net monetary liabilities get smaller in the reporting currency, and that gives you a gain. Now, of course, with a net monetary liability exposure in a hyperinflationary environment, under IFRS, you get a purchasing power gain. So notice, if you've got net monetary liabilities, both methods will give you a gain in the income statement. If you have net monetary assets, well again, both will give you a gain in the income statement. Notice our monetary assets and liabilities are exposed to changing exchange rates, whereas our monetary assets and liabilities under IFRS are exposed to the risk of inflation. Their purchasing power essentially is being eroded. Okay, so notice the gain or loss from changing exchange rates is in the income statement. The purchasing power gain or loss due to the erosion of power of your assets and liabilities is a gain in the income statement. So different methodology, but it results in remarkably consistent end results. Now we turn our attention to multinational operations and tax. We're asked to explain multinational operations and how they affect our tax rates, in particular our effective tax rates. Now certainly what we're worried about when we look at multinational operations is transfer pricing. The idea that goods could be sold around group companies below their true commercial value. In other words, we might be selling goods between companies essentially below the true commercial value. They're not proper arm's length transactions. Now of course what we could therefore do is use this to shift profits from high tax countries to low tax countries. In other words, if you've got a low tax regime, allow that to buy goods from your subsidiary in a high tax rate regime at prices way below the true economic value. And what that's going to do is shift profits from the country that has essentially the high tax rate into the country that has the low tax rate. Now, of course, this has been the focus in the international media recently for a lot of companies, and they've been criticized essentially for shifting profits and making sure profits are being recorded in low tax rate regimes. Certainly Amazon has been accused of this, Google essentially, Starbucks, etc. have all been in the media. Now, countries have laws to prevent aggressive transfer pricing. So again, if it can be proved that the terms of the goods being shipped between divisions, subsidiaries are not proper arm's length transactions, then again the tax authorities may step in. Payment of domestic tax on overseas income will vary globally, absolutely it does, but tax treaties prevent double taxation. Now the idea therefore is if I'm a UK company, not only do I get taxed on my UK earnings, but I get taxed on my global earnings as well. So let's say I've got a US subsidiary, I'm going to get taxed on my global earnings as well. Problem is that US subsidiary is being taxed in the US as well. So a double taxation treaty will essentially offset some of this tax. Now we're asked to be aware of the reconciliation from the statutory rate. This is the rate at which you're paying in your domestic country, i.e. your reporting currency, your head office currency, the presentational currency, and we've got to reconcile it to the effective tax rate. Now you might remember effective tax rate from level 1. It's essentially the tax expense over earnings before tax. Now of course they may differ. Now of course they may differ because of disallowable expenses, items that hit the income statement that aren't going to go through the tax return. Notice disallowable expenses essentially are increasing the effective tax rate. Exempt income, so income that's in the income statement but doesn't get taxed. Well again, this is going to reduce the effective tax rate. Now, what we're particularly interested in this reading is this line here. Now, this is the effect of taxes in foreign jurisdictions. Now, we've got two companies here, AMCO and Bianco. AMCO, notice this is increasing its effective tax rate. That's a good indication that its overseas subsidiaries are paying rates of tax in excess of its statutory rate of 25%. Bianco, though, notice the effect of its foreign taxes in foreign jurisdictions, minus 1.2. So its indication is its subsidiaries are operating in lower tax rate regimes. Notice its presentational currency has a tax rate of 30%. Its subsidiaries are obviously operating in tax regimes with lower than 30%, and that, of course, is pulling the effective tax rate down. Recognition of prior losses, this just simply says if companies make taxable losses in one period, what they can do is they can roll them forward to offset against future taxable gains. So you can see that's actually reducing the effective rate for AMCO. Okay, so we see that reconciliation, but there's the line that we're interested in. How do overseas subsidiaries affect our effective tax rate? Okay, so look, the effect of foreign operations resulted in an increase in the effective tax rate by 3.4, indicating for AMCO its foreign operations are operating in higher tax rate regimes, but a decrease in the effective tax rate for Bianco, indicating its foreign subsidiaries are operating in lower tax rate regimes. Now, what that means essentially, if Bianco's overseas operations increase in size, increase in terms of their revenue from the group perspective, then the tax expense is going to essentially reduce. Whereas if AMCO, if its overseas operations increase proportionally in the group, then of course that means its effective tax rate will increase. AMCO's overseas operations are in higher tax rate regimes, Bianco's in lower tax rate regimes. Okay, earnings sustainability. We're asked to explain how changes in the components of sales affect the sustainability of sales growth. Okay, we're also asked to analyze currency fluctuations and their effect on financial statements and sales growth as well. Now, organic sales growth, of course. Organic sales growth is coming from natural expansion of the company. In other words, capital expenditure decisions, as opposed to mergers and acquisitions where we go out and acquire overseas subsidiaries. Now, the argument here is organic growth in sales is typically more sustainable than actually increasing your sales simply by acquiring other companies. Currency effects on reported revenues are going to distort sustainable growth estimates. In other words, we might think that the sales in the presentational currency have increased dramatically. Now, that might simply be because essentially overseas exchange rates have essentially appreciated dramatically against the reporting currency. So what we're simply saying is exchange rates can distort our opinion of sales growth. Now, what we're saying then is, look, when we look at sales, the management can affect the volume of the sales, the price of the sales. So quantity and volume. What they can't affect is overseas exchange rates. Okay, what we're also arguing here is that currency effects typically mean revert. So, for example, the last 5 years, if you look at the dollar against the pound has been buying about $1.6 for the last about 5 years. Sometimes it's slightly more, sometimes it's slightly less, but it seems to be mean reverting around the level of $1.6 to the pound. Now, what that means is we might suddenly see an improvement. Let's imagine we're recording sales in dollars. So the pound strengthens, it buys more dollars. So when we convert our UK subsidiary into dollars, our sales figure increases and our sales goes up. We think, great, higher sales, fantastic sales growth. But of course, then the pound mean reverts back down. So the pound weakens against the dollar. It's now buying less dollars. So sales in subsequent years might fall in dollar terms when we convert them from the UK, from sterling into dollars. So all they're simply saying is, look, be careful. Any growth in sales that's been generated from exchange rate movements is often not sustainable due to mean reversion. Now, what that means, of course, is when we're looking at forecasting future revenue, we need to be very careful to strip out the effects of exchange rates. Now, finally, currency effect on profits. Now, we've said currency value fluctuations, exchange rate fluctuations, do affect the company's reported results, its net income, due to transaction exposure, gains and losses on imports and exports denominated in overseas currency, and translation effects under the temporal method, of course. Remember, temporal method, exchange rate gains and losses into the income statement. Now notice, we've said transaction gains and losses are genuine economic gains and losses, whereas translation effects are essentially largely due to the accounting methodology and therefore not genuine economic gains and losses. Problem is, there's no requirement under US GAAP and IFRS to separately disclose them, so they can be grouped together. Now the problem is, as an analyst, I want to see them separate because I really want to either praise or criticize the company on its transaction exposure, but I don't really care so much about translation effects. Now, as it happens, most companies will voluntarily split transaction and translation in their footnotes, but there's no requirement to actually do so. Okay, so notice, what are we going to see in terms of IFRS and US GAAP disclosure? You can see exchange differences that have hit the income statement, so total gains and losses hitting the income statement. As we said, they don't have to split them, but often might. And also, there's a reconciliation of the opening and closing cumulative translation adjustment if you're using the all current rate approach. Okay, so what are our keys to our exam for this reading? Number one, getting the correct method. And of course, that's all about spotting the functional currency. Okay, you've got to be able to spot that functional currency. And that will tell you whether you're using the temporal or the all current rate method. Then, of course, certainly being able to convert the financial statements, and once you've got those financial statements, no question in the exam would be complete without testing. Do you know how it affects your key ratios?